Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending February 7th, 2025. And this week I am titling the video, "The Mag 7 and the Economy Show Signs of Weakness." And that was really the story of the week. And we'll look at the economic data, but I'll start off with this chart. By the way, I'm host of InvestTalk, Justin Klein, and I encourage you to like and subscribe to our channel and hit that bell notification as well so you get notifications whenever we post. Now, this week, the Mag 7 outside of NVIDIA and Meta did pretty bad. Tesla down nearly 10%. You see that over here. Amazon down 3, Apple's down 8. Google had earnings down 8, Microsoft down over 2. Netflix had a good earnings, Palantir had good earnings, but you look around and Adobe down 3, Intuit down 4, Salesforce down 6, and then you even dig into some of like BlackRock down 7, KKR down 11%. So definitely spots of weakness. Union Pacific, big railroad company, down, even though Uber was up. So mixed bag, but what you can see is kind of a lot of dark red and dark green. And that's not something you typically see. There's a lot of stocks moving in different directions and in big magnitudes as well. And so when volatility like this kicks up, this oftentimes is a sign of potentially a market top. Now, I'm not calling it, but I do want to make note of that for this week. Now, it's 1 week. It's not something you take action on, but it is a way to color this week. And so I wanted to first start off with that. Okay. And the fact that, the Mag 7 NVIDIA bounced, but, still is not nearly close to recovered from kind of the DeepSeek sell-off. Now let's pivot over to the economy. Construction spending, that did tick up a bit. The one thing I will say is this is kind of bottoming out here around 3. It's not what we were in 2019, but, if you get the Fed easing for any reason, rates dropping, this could be a nice tailwind to the economy, because what's showing is that right now construction spending is not great year over year. Probably what's holding out, obviously, the commercial real estate market not doing so hot. But if you dig into the housing market, the locked up inventory at 3% mortgages is kind of continues to create demand for new homes. And so I think that's what's holding this number up. Okay. But that is a potential catalyst in the future if you do see Fed easing, rates come down, et cetera. Job openings, that did tick down again. I still don't love this number. It's not my favorite number to look at to see what the job market is doing, but certainly ticked down to the second lowest level over the last year, 2 years. ISM PMIs, services PMI, excuse me. Remember, services are the vast majority of our economy. It's not making physical goods, and that did tick down, 52.8. Remember, anything above 50 is still growth. So there's still growth here, but it's not as, it looks like this little bounce here is starting to peter out, right? Higher low. And then the prices paid index, that did come down a bit, from 64 to 60, so kind of back to where it was kind of in November. So what it's showing is that inflation looks to be, while it's no longer declining, pushing towards that 2% rate, we're kind of hanging out in this 2.5 to 3% rate on inflation. If you look, that just confirms kind of last week's numbers on PC, et cetera. So that's why the Fed is kind of on pause, because we're not pushing back down to 2%, so there's not as much impetus to ease. They don't want to hike rates and cause a recession. Okay. Pending home sales that did tick down again, negative 5%. So we're still kind of in this negative territory year over year. And once again, we have rates going up, and mortgage rates are. What's the mortgage rate? That's not mortgage. There you go, 30-year mortgage rate. Where are we at? Yeah, last week it was 6.89. Right, we're still kind of hanging around the 7% mark. Clearly, the market doesn't like that, and then clearly the housing market is not doing well with that 7% mortgage. The continuous claims for unemployment, the jobs market. What this is telling me is that the jobs market is weakening. The fact that mortgage rates are flat, right, but we had the pending home sales decline, is saying that it's not really the high mortgage rate as much as it is maybe the jobs market weakening as well. So continuous claims for unemployment that did tick up again, once again, second highest level over the last year. Consumer sentiment did tick down again as well. And then you have non-farm payrolls that came in on Friday at only 143,000. The market was expecting 170,000. So the jobs market is weakening. That is clear. And so that's what I say in the title of this video. Mag 7 is weakening and the economy is weakening. Now, is it saying there's going to be a recession starting soon? No, but it will give the Fed more impetus to ease. And I could see, the dollar weakening. And I'll pull up that now. As there's starting to be because right now it's okay. What the Fed's going to do? They're going to ease, maybe one or two more rate cuts by the end of the year, but not any more than that. I think that could start to widen out as we get through the first half of this year. If you get a broader market pullback, which we expect, it's pretty clear that the Fed wants to, or the Treasury needs the Fed to stop QT at some point. And that's something that I'm on watch for as well. So I think the dollar very well could have topped here. Okay. The yen is even gaining strength compared to the dollar. Okay. That's the yen. Here's the euro. The euro is only one that's really not doing as well, just because the broader economy, the Swiss franc, also kind of looks like it wants to find some support here. So what I'm seeing is a U.S. economy that is finally weakening. And I've said this before, you get in the back half of this year, the credit refinancing cycle begins in earnest, and that could cause bigger problems. All right, let's dig in some more charts though. Here's the Nasdaq. We talked about the Mag 7, and look at this MACD. This momentum's not good. Okay, you had that sell off mid December, and really we've been chopping sideways. This is what we just call bearish consolidation, right? Until you get above this high bar from December 18th, this is bearish. Simple as that. Till you close above that, this is a bearish pattern. Now it's a micro bearish, right? A near-term bearish pattern in a broader uptrend. So what this likely means is you get some move like this. Do this. So you go to the top of this. Oh, I didn't want to do that. Let's delete that. I want to do this. That's what I want to do. Let's go to the top of this and take the bottom of this. And then we copy this, and you usually get a measured move here. Okay. So whenever this breaks, you're going to get something that brings you down to here, right, on the NASDAQ. And you have similar pattern here on the S&P. Now this closed above it, so it's not as bearish, right, as the NASDAQ. It shows you that the next pullback in markets probably is going to be led by the tech names. And the last couple weeks kind of confirms that. Okay, here's the NYSE. This is just more of threatening a lower high than anything else. Let me go to like SMH, right? This has been kind of bearish. Go to weekly. This is kind of the micro bearish on the weekly. where you have that big sell-off and then just kind of chop sideways. Look at the momentum on the MACD. That's pretty negative. And then you pop over to, some of the bigger names, right? NVIDIA with a nice bounce back. You have to give it credit for that. It did close above last week's high, excuse me. So that is, you're getting into the gap. So typically when you get into the gap, you fill the gap. That would go all the way up here to 142. But you also typically need a confirmation. We're only one day. We'll see where we close on Monday, Tuesday. We need to get a confirmation again higher from for Friday's close for that gap fill to be the likely scenario. Right now, it's just in play. Just to say that. Look at other semiconductors. AMD, obviously, they had earnings, not very good. Intel, still a little weak on that side. You had names like Skyworks that had earnings that were poor. Qualcomm, they had good earnings actually. Yeah, they had good earnings. It moved down a little bit. I guess the market didn't like it quite as much, but still, obviously, in this mini uptrend. So nothing bad on that front. So that was kind of the semiconductor space, and obviously, what NVIDIA will do next week will have a big driver to where those names start to go. Let's look at Apple. Apple definitely had a reversal here, reversal candle, a rough week overall, and I think you get a lower low here. So our target is closer to 200 to pick it up on Apple. Maybe it only gets to 212, but 200 would be a great pickup, right? This low, this reversal candle, that'd be a great area to pick up Apple. So just a heads up there. But definitely on the weaker side near term. Google had earnings that was worse than expected. They're spending on AI, and I don't know if there's other catalysts, but yeah, definitely the market didn't like Google nearly as much as some of the other Mag 7 names. Amazon also had a rougher week, kind of had that rollover on Friday on volume. That's of note, right? Look at that volume. Highest really since back here on December 20th. What were the other names that were interesting? Let me look at some of the ratios. I love those. This is interesting too, is you have a lower high. This is the short-term junk to short-term treasuries. So when this rolls, it means credit spreads are widening out. And as I said at the top of the show, KKR, right? Look at KKR. This is your private equity, your the entities that have levered balance sheets are subject to the downside of a credit cycle. BlackRock also, right? Double top here, terrible momentum on the MACD. As I go through this, right? Is this the start of that credit cycle? Are we starting earlier than expected, right? Where there could be more pain ahead for anything that is tied to, once again, levered balance sheets. And is gold telling the story? All right, look at gold. While it's a bit overbought here, probably chop sideways, maybe pull back. This is a strong chart, and China is buying gold hand over fist. So, it still remains the most attractive area of the market as a whole. Let's take a look at uranium. Uranium also is, let's go to URA. That's a little bit better. Yeah, it had the pullback here. Still kind of in this choppy period, but overall, I think still bullish. Right? You tested the 200, now you're testing the 100, higher low, higher high. It's a choppier uptrend, but it's still in that uptrend. So I think there's still some good things working there. Let's look at industrials. It's always kind of a canary in the coal mine, I guess you could say. This is kind of neutral, to be honest with you. It's making a higher low here. That's of note. But these are also, typically like mid-cap names. So it looks a lot like the mid-cap index in many ways. Let's look at small caps. Small caps also looking a bit bearish. Mid caps definitely looking kind of the best, although still kind of neutral. Let's take a look at growth to value. So it's interesting, isn't though Mag 7 had a down week, or rough week overall, this still got a bounce. And I think mainly it's because, if you look at some of the value names suffered, definitely not financials. But also Nvidia is obviously a big weighting on the S&P growth. So that got that bounce. So I think that was really drove it. But I'll be very interested to see if this makes a new high as well. Does this roll over? Is this this is already look at the MACD momentum. You're threatening the zero line. This would start a downtrend in the growth side of the market. But so far it definitely in an uptrend. But the momentum is waning. So I'll be watching to see if there's a break there next week. Where is money rotating? Let's take a look at utilities. Utilities had a decent week overall. Let's look at treasuries, because we know treasuries are important. You see the 10-year rallying, but still in a downtrend. Obviously, if you get into a recession, there'll be more flight to safety, flight to treasuries. I think this would get more of a bid. But in general, you're still in a downtrend, a longer-term downtrend in treasuries, and I don't think that's going to change. Could you get more chop here for a little bit longer, another year or two before you get higher rates? Sure, I think that's possible. Let's take a look at the VIX as well as the MOVE index. So the VIX is still hanging around 16, but it's trying to bottom here, it looks like to me, and go for another one of those moves up like we saw back on December 18th and that next follow through. And I think that's in the offing. And then lastly, the MOVE index. This is the one where I'm saying, okay, it's still looking okay. You are getting a micro bullish pattern here. And remember, this is similar to the VIX, where higher the volatility index, whether that's on treasuries or equities, which that's the normal VIX, that's bad for markets, right? Markets like calm, both on the stock and bond side, so they can know what to expect. When those markets get unruly, people start taking risk off the table. And so those aren't showing signs of, a big jump next week, but, could happen in the next few weeks. Just say that. So I am starting to get, I've turned kind of neutral to modestly bearish on the markets near term. Now, ultimately, I think the Fed eases into that if they get some sort of break, right? Some sort of risk off event. And that's what it could be. There could be something under the surface. Think of Silicon Valley Bank 2 years ago, and nobody was talking about that. And something else rears its ugly head that nobody's talking about. That's typically what it is, right? The things that people know are happening or risks, those typically don't bring down the markets because they're discounted. It's the things that nobody's thinking about. There's some big failure, and now everyone questions the safety of something, right? It was the question of the safety of these small and regional banks 2 years ago. Could the next thing be looking at like a KKR? Could there be a private equity fund that goes under, right, underneath the surface that says, okay, the KKRs of the world, the Apollos of the world, aren't where you want to be, and then credit spreads widen out, and there's more risk of defaults. And guess what? The Fed has to ease. Dollar weakens. You start to maybe get inflation rising again, kind of a stagflationary environment. That would be more of a worry. But once again, the Fed, especially with Trump now, they're going to want to ease, stimulate the economy, etc. And so, and that could be the catalyst here too as well. Is this something around Doge? Do they pull the purse strings of government spending back too fast? Because we know that the GDP figures, just for everyone out there, C plus I plus G plus X. This is the calculation for GDP. It's the first thing we learn in business school is how do you calculate GDP? C is consumer, I is investment. Okay, consumer comes from the consumer spending. I is investment, comes from businesses. Okay, how are businesses investing in plant, property, and equipment? G is government spending. Are government spending more or are they spending less? And then X minus I is exports minus imports. So for us, right, that net export number is negative, and so that's a drag on GDP. And the G typically goes up, typically is a tailwind to GDP growth. But if Doge comes in, starts hacking away at the budget, maybe good in the long term, maybe smart for the efficiency of our government. Not arguing that, whether it's good or bad, but the facts on the ground are real. That's people getting furloughed, laid off, money not going to entities that typically get money from the government. Once again, not judging whether that's a good thing or whether what they're doing is smart or stupid or whatever, legal or not legal. That's irrelevant. Talking about what's its impact on the economy. Is that what the market is kind of sniffing out right now? Could be. Could be. So just wanted to highlight all that. I hope this gave you a broad overview of where markets are now as we're well into this year now. We're good 5 weeks, 6 weeks, and we have the Fed meeting, so that's kind of in the back burner. They're not doing anything. There's no Fed cut that the market is expecting in the near term. March is, what are we at? 92% no cut. May is 74% no cut. June is the first time where it gets like 50-50, right? A little over 50% chance we'll have one cut between now and June. And so, yeah, that's where we're at. And hope you enjoyed this video. Hopefully, got a lot out of it. A reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.